With every single investment you make, there is always going to be expectations and risk. In today's episode of Stock Due Diligence, we are looking at how you can manage those factors effectively. How's it going, guys? Ryan here and welcome back to the Stock Due Diligence series, episode 5, and today we are taking a look at expectations and risks when investing in a company. But before we get into that, guys, please remember to give this video a thumbs up if you do enjoy it, and subscribe for more investing, stock market, wealth management and cryptocurrency content. I'd also love to know down in the comments section below your thoughts and some activities that you take into account when considering the risks and expectations set out by an organization before you invest. So without further ado, let's get straight into today's video. So why is considering the risks and the expectations outlined by the company so important? Well, effectively it is going to make a major impact on your judgment on whether you should invest or not invest in a company. And the reason for this is the risks, for instance, could be too high for you to put a lot of money into a company, so instead you may only put a small portion of money in as a result of that. As well as that, companies obviously set out expectations, they put out timelines, all those sorts of things as well. You want to make sure that those expectations that the company presents are being met and they are sticking to their words, sticking to their timelines, all those sorts of things, because if they're not, then the company may not be reliable and may not be looked upon favorably by the market. When investing in a company, with regards to looking at the expectations and risks, there are a few key factors that you need to consider. The first factor to consider is company estimates. As I mentioned previously, the company will set out expectations, whether they be financial, whether they be timeline based, or whether they be managerial, with regards to what they are going to do. The next factor you want to consider are industry trends. What are the current trends in the industry which will result in, for instance, demand significantly increasing with this company's product or service or whatever it may be? What are the industry trends which factor into the expectations that you have for this company exceeding their said goals and all those key factors? Thirdly, upcoming news. What expectation has the company set with regards to timelines? Have they said they are releasing important news in the coming weeks, in the coming months? And if so, are they meeting those targets? The fourth, known risks. What risks are you currently aware of before investing in this organization? And what risks are factored in by the organization themselves? So for instance, do they highlight the risks to their investors, or are they painting a picture which is all sunshine and roses? Make sure you understand the known risks and factor these in to your calculations, to your expectations and these things. Fifth, external risks. What are some external influences that are going on in the world at the moment? They may result in your company decreasing in value, for instance. So let's say we are potentially expecting a crash in the market. Is that going to affect the value of the company you're investing in? It may be worth holding off for the time being. The final factor I want you to consider, and one of the hardest factors to consider, are unknown factors or unknown risks. What don't we know? Obviously, it's hard to work this out, but we need to keep it in the back of our minds and factor it in before we invest in an organization. The first thing that everyone sees when they start looking at a company is the expectations that have been laid out by the directors. And this is effectively the draw card. What expectations are the directors setting? So for instance, if they are a gold mining company, are they saying we expect to generate a 10 million ounce resource? That's an expectation that is readily set, and you'll often see these expectations be set out by the company in the highlights sections of their quarterly reviews, in their investor presentations, and in their interviews with the managing director. Identify what these expectations are, and go back in history as well and identify the expectations the company has set out in the past and whether they have met these expectations or whether they haven't met these expectations. This has a major effect on a few factors. The first of which is investor sentiment. You're not going to want to invest in an organization which can't meet the expectations which it sets. This is a huge turnoff for investors, and it will naturally result in the price of the stock deteriorating. The second factor is if they're not meeting those expectations, then are they actually going to be as successful as they say they are? Are they really driven? What else are they not hiding? What else are they hiding from investors? So keep that in the back of your mind. Make sure you temper your expectations. Take everything with a grain of salt and rely on the historical ability to perform effectively by the organization and the management team overall. The second factor is industry trends. What is going on in this industry that the company you're investing in lives in order to see, I suppose, an increase in the valuation or a decrease in the valuation now and in the future. So if we go back to the gold mining company, for example, a very basic factor we consider from an industry trend point of view is the trend of the gold price. Is the gold price in an uptrend or is it in a downtrend? That is a very basic industry factor that we can take into consideration to work out the valuation of the company now and what people are expecting it to be worth in the future. And often what we'll see is companies use these sort of factors in their presentations to value the company themselves and present that to potential investors. So make sure you understand the industry trends that are currently ongoing and where the trends are heading in the future, because ultimately you're investing now, but you're exiting at a certain point in time, or maybe you're in it for dividends, but you're looking for a return at the end of the day. If the trends are positive, you're going to likely make more money than they would be if they were negative, unless they are an absolutely insane company. Keep in mind, people will literally invest in organizations based on industry trends. If the gold market's hot, people will invest in gold for the sake of investing in gold. If it's not hot, they'll focus on other things instead. The third factor to consider is upcoming news. What is the timeline that has been laid out by the organization for any relevant events that are going to be occurring within the next few months, within the next few years? You want to understand if these timelines and these factors are being met. So, for instance, if we use the gold company example, are we expecting to see drill results from that company within the next month? If they haven't been received, why is that the case? And have they been able to hit their targets in more recent history, in the past? And what can we expect as a result of that? Make sure you take a look at the timeline. Make sure you take a note, particularly of specific dates. More often than not, they'll be listed by month as opposed to by an individual day. Make sure they are hitting those factors. If they're not hitting those factors, then effectively investors are going to be disappointed, and particularly when you're looking at people who trade shares, then what they're going to do is sell if they're not receiving what they're expecting at the right time. So keep that in the back of your mind. The timeline and investor presentations are incredible factors you can look at. Pieces of information are in there that are literally listed out line by line, and they are traceable. You can write them down on a spreadsheet. So when you're considering investing in companies, make sure you write down the key factors and the key dates of the timeline. The fourth factor you want to consider is known risks. And these are the easiest risks to understand and manage, because more often than not, they will be identified by the company themselves. A great example of this is the automotive industry. A known risk is that countries are moving away from fossil fuels. So effectively, they want cars which are electric, and they are putting bans in place. That is a known risk for car manufacturers. And the reason it's a known risk is because they know the exact date they cannot sell their petrol or diesel cars to those countries. So effectively, how are they managing these known risks as well? Are they transitioning, for instance, to electric or hybrid vehicles? Are they doing it now? Have they set an actual date for it, going back to the timeline perspective? These are known risks which should be managed by the organization. And it's great to be able to identify these, and then if, for instance, you're performing your own due diligence and calculations from a financial perspective, adding in an element of risk when calculating the stock price. For instance, if this company is not transitioning away by a certain point in time, and that is 20% of their market, that country, then effectively that is going to result in a hit to the stock price, because all of a sudden they're going to have no sales due to the fact that they didn't transition to electric vehicles and can no longer sell petrol or diesel vehicles to that country. So make sure you note down the known risks, how the company's dealing with those known risks, and what the influence or the effect will be on the company and the company's stock price. The fifth factor to consider is external risks. What are some external influences, including the industry trends we were talking about previously, that could result in the stock price deteriorating? Once again, let's go back to the EV example. If we have countries which have put these restrictions in place, these are uncontrollable risks. So the company needs to be able to identify and manage these risks internally to mitigate an effect on the organization. These are uncontrollable, unfortunately, in the majority of cases, and result in the need for mitigation as opposed to avoiding. Another risk may be a natural disaster has occurred, and effectively that's an external risk which is out of the company's control. It might affect their supply chains, it might affect their production lines. All those sorts of things are external factors that you need to take into consideration. Other external risks may be things simple as a global economic collapse. And that is a big one, and that's something that, while it might not actually affect the company itself in a major way, it may affect the company's stock price because it's just a deterioration effectively in sentiment across the board. The sixth and final key factor that I want you to consider, and this is by far the hardest thing to determine, is unknown risks. And the reason unknown risks are so important is because they will just come out of the blue. And if these risks actually eventuate, then they can have a major impact on the stock price because the market effectively hasn't priced it in to the company's current valuation. So what can you do in order to mitigate these risks? Well, effectively a great way is to just apply a blanket percentage, 10 to 15% on your valuations. And the reason for doing this is because you genuinely don't know what is going to happen. But it also allows you to temper your expectations and allow for a buffer if something was to occur. So for instance, if you're expecting the stock price to increase to $1 in the next year, and you put a factor of 10 to 15% risk along that, then you've given yourself, I suppose, a 90 cent to $1 to $1.10 range to effectively deal with. Because when we're considering these unknown factors, they may be really good, so they may influence the stock price in a positive way, or they may be things that are really bad. Example, once again, a natural disaster resulting in the production of an organization coming to a halt. So factor these in with some elements, just temper your expectations because no company in the world is going to run perfectly smoothly. Every company has to deal with risks, every company has to deal with issues that do actually eventuate and will have an impact on the company's performance, efficiency, and overall valuation. And that covers some of the basic factors that you need to take into consideration when performing stock due diligence. I hope you did enjoy today's episode, and if you did, remember to hit that like button. It helps me out so much, and subscribe for more of this sort of content. We cover stocks, the stock market in general, investing, wealth management, and cryptocurrency content. If that's up your alley, definitely make sure you hit the subscribe button. I'd love to know your thoughts as well, and some factors that you take into consideration when tempering your risks and your expectations down in the comments section below. And with that, guys, I hope you have an awesome day. I'll see you next time. Cheers.